As we begin, startup fundraising is the sort of thing that's a perennial topic. My experience of working with various types of founders is that fundraising is potentially the most painful thing you will do over the course of your journey as a startup founder. And given typical VC-backed models, that means you'll be going through substantial pain every 2 or 3 years or so. Sometimes even more often than that, depending on what you're doing. Every so often, we get a new batch of founders who are looking to fundraise, who have big dreams, and are putting themselves through this pain. We are here, hopefully, to relieve some of that pain, not because it's going to become inherently any easier, but because we can provide a bit of guidance on how investors are thinking about the current environment and how they're behaving as well. So here to draw back the curtain, we have two very qualified, very well-informed investors. I can continue to heap praise, but I think the better thing to do would be to let you guys introduce yourselves and talk about what you do. So in the interest of raising the energy level in the room, what I'd like you to do is introduce yourself, your fund, what sort of investments you do out of that fund, but also one thing that has you actually excited in the midst of all the chaos and turmoil in which we find ourselves these days. One thing that you're most excited about in the next 6 months.
Hi everyone, my name is Juncture. I'm from Insignia Ventures Partners. We are a multi-stage VC fund. So we invest across pre-A all the way to Series B, ticket size in between 1 to 15 million USD. Right. So from a sector perspective, we are more of a generalist fund, although historically we have done quite a bit in consumer as well as fintech. As to what we are excited about in the next 6 months and all this, we do feel that with the advent of the generative AI era, there's an opportunity for us to combine service-heavy business together with AI and all this, right? So I think for us right now, we're actually exploring business models, investing into business models whereby it's a little bit more traditional, but there's opportunity for us to come in to conduct massive digital transformation, to revamp the way things have been operating and all this, right? And I guess another thing from that is that I think in this part of the world, there's also an opportunity for us to combine AI hardware as well as supply chain as well. So we're also looking for strategic opportunities. And we do see a number of these opportunities coming from the China outbound corridor. Yeah, I think these are two particular areas that we've been trying to spend a bit more time on these days. Yeah.
And what do you personally feel most hyped about?
Yeah, I do feel that the China outbound corridor has quite a lot of interest, at least from my perspective. I think with every new set of opportunities that emerge, there's always a certain time window whereby funds like ours can capitalize upon. And I guess with the way policies are being run in China and the whole macroeconomic environment and all this, we do feel that there's a good time window for us to really act upon and really capitalize on these opportunities, at least with the China outbound corridor. Right. And we're not just seeing the outflow of capital, we're actually seeing the outflow of very tier one talent. Historically, they would rather stay in China to compete domestically. Right now, they're all coming out in massive waves. Yeah.
It's very. All right.
Hey everyone, my name is Navas. I'm the executive for Mars Growth Capital. Mars is MUFG fund. Technically, MUFG is Mitsubishi UFJ Financial Group. It's a Japanese bank, one of the largest banks in the world. Today, we manage close to $1.25 billion as under management. We also have an equity fund, but I'm primarily on the private credit side. When startups are looking to scale their businesses, grow their businesses across borders, we're looking at raising more capital and doing that in as non-dilutive as possible, right? So what's the alternative to equity, which is the traditional form of fundraising? And that's where people start talking to people like us. So we can give anywhere from $5 million to $100 million. So we're talking about companies that are post-Series B, ideally, raising capital from us. We are, as most players in our segment, we are very agnostic about the kind of businesses we can finance. Of course, there are certain businesses which become more difficult for us from a KYC and other perspectives, but ideally we're looking at companies that generate revenue and grow their business and have some cross-border element which means they need dollars. Obviously, this is not an easy time. A macroeconomic situation is very interesting. But what excites me is the fact that what we're seeing over the last, let's say, 1 week or so is that equity markets have shut down. People are not taking any decisions, which automatically means we get a lot more calls on the credit side. Because people start wondering, hey, you know what, I need to raise capital. And you basically talk to people who are actually taking the calls. But that being said, yes, it's a very interesting and tricky time. I'll go into details, but my thinking is that this is the beginning. at least since COVID, we've been having this rearrangement in how capital flows, etc., etc. Today, 75% of the capital is concentrated in the US, the capital markets. I think with what's happening, a lot of people are started thinking maybe it should move out. And that's what excites me, because I think Singapore is really well positioned because of its neutrality and the fact that it's always had this rule of law. So this is what really excites me, that I think there's a scope for us to build something amazing in the next 10, 15 years.
And so I guess Liberation Day was about liberating capital from America, huh?
Yeah.
Okay, cool. So taking a quick poll of the room, how many of you in the room are founders of some sort? Okay, and how many of you are actively raising capital right now? Okay, a few of you, all right? You guys can go pitch them later, afterwards, the panel, please. But when we think about the current macroeconomic environment, we've just started coming out of a funding winter in a way, right? We had some, at least in Southeast Asia, we had some month-over-month growth between February and March when it comes to total capital deployed. Year over year, I think it's still not looking very good. We were about like 80% down from 2024 or something like that. But there was, at least from my corner of the woods, some discussion about coming out of the funding winter. Now, of course, with all the stuff that's coming out of the US right now, between tariffs, policy uncertainty, general unpredictability, let's say, how are you guys now thinking about the situation? For me, it felt like kind of the animal spirits were coming back, and now no one knows what's happening.
I'll go first, maybe. So my view is that Southeast Asia in general as a region is going through a very tough time, especially in terms of fundraising. And we should be honest about it. We should understand that there's a problem here. It's also because you had a COVID period when a lot of capital was being raised, right? And was that capital going into companies that really were generating real value? Unfortunately, soon investors realized, and most of them global, right, or foreign investors, they realized that maybe some of these companies are not generating the kind of value, or they don't really have the kind of value that they perceive they have, right? Which meant that a lot of this capital actually went out or either got stuck, and then there was no more follow-on capital to come into the region. So we were already in that cycle. There's no, I think if you look at some of the countries, I'm not going to name the countries, some of the bigger countries that drive capital flows in the region have been suffering over the last 10, 12 months. Now, Singapore is definitely an exception because Singapore is also housed to not just companies from Southeast Asia, but it's also housed to companies from everywhere. And when you look at it from that perspective, I believe Singapore, of course, has to position itself as a pivot or as the hub for Southeast Asia, but maybe also look outside of Southeast Asia where it takes a more larger role, which probably means that if we can create a more financial hub, which also involves venture capital, venture, private credit, and all these things, then our startups can survive and thrive and go do it in the global scale. What we definitely need is a lot of innovation. We need to decide what we're going to focus on. But in my view, not the easiest time to raise funds, but it's never been easier outside of the US. It's always been difficult. I believe this just gives an opportunity for all the founders in the room to just hit reset, slow down, understand what investors would want. Most likely that most investors will not be taking your calls in the next few weeks. That's not because they don't like you, it's just because they don't know what they have to tell you. Even if you ask me, I don't know what's the impact of what has happened over the last week. I know some of the larger funds are getting calls from their LPs who are asking to liquidate their illiquid positions at a discount. Automatically, when LPs pull capital, funds are under pressure. Of course, we are lucky to have a very stable, larger organization, but I know a lot of the PE larger funds suffering at this point in time. This will trickle down to the VC ecosystem as well. But yeah, this is my point, but yeah, we can talk more about it.
Okay, we'll come back to the point on what investors want, because I think that's quite critical for our audience today. But what are your thoughts?
Yeah, maybe first of all, I'd like to highlight that we are still open for business, right? So feel free to reach out to us. Maybe what I'll share about is how has funding or investment trends have sort of shifted over the past 1-2 years and all this, right? Because once the bull cycle is over, we actually saw quite a big wave of retreat of international funds, of regional funds and all this, right? And that has influenced the way VCs have thought about investing, right? So right now, the assumption is that we are assuming there's no follow-on capital. So in the context of that, what do we actually invest in, right? So you see a flight of investments towards more profitable business and all this. And what that translates to is that you tend to see VCs, at least in the past 1-2 years, investing more in consumer brands, to a certain degree, offline retail businesses. Whether a VC fund is the right type of setup to do that or not, I think that's debatable. That is also what we have seen as well. At least on the portfolio side, we have also taken this opportunity, especially for those with sufficient war chest, to really impose financial discipline as well. A lot of the things that they have not been able to do in the bull market because they were so caught up in trying to keep up with growth and all this, we've been trying to get them to get a lot of the fundamentals right so that when the markets turn, when the tide turns, they are in a very strong position to capitalize on all this inbound interest, right? I'm assuming it comes back at the end of the day, right? And I think for us, we are also increasingly looking for businesses or models that have a potential to scale globally as well as regionally, especially right now. I think the barriers setting up businesses, especially software businesses, is a lot lower as well. Although I think the barriers to defend that business is also raised substantially higher as well. But I think what we are looking for is really teams that have global ambitions, regional ambitions, and to be able to define what success might look like in the next 3 to 5 years. I would say that we don't have a crystal ball. We are in this co-discovery process with a lot of the founders and all this. But yeah, that would be what we are seeing these days.
I think both of you raised some very interesting points. There's been a very well publicized pullback from the region. The global funds like a Tiger pulled back, I think, quite a while ago. And then even I think over the past few weeks, you had news about P15 now is pulling back. Even though it was founded essentially as a India and Southeast Asia fund, now they're expanding to the US, they're doing more in Australia and so on. Presumably for our audience, they are based in Singapore or somewhere close to it, may have a Singapore or a global thesis. How should they approach fundraising conversations, and how should they approach the overall strategy and narrative for their firm more broadly? What can we view as an investable asset in venture today? To your point, there was, I think, more capital going to consumer brands, but going to retail. For me, that feels like it's maybe not the best match for a VC as traditionally perceived. I could be wrong about this. How are we thinking about how they should tailor their own business, their own strategy, particularly on fundraising, but also for their overall development, given the current environment?
Maybe I'll go first from an equity side of things. I think fundamentally for us, the way we evaluate startups have not changed dramatically. At the end of the day, it boils down to how defensible your moat can be. And I would say that especially if it's a software business with generative AI these days, the pathway to 1 mil ARR, right, it can be a lot faster, right? It's sort of like hyperscale and all this. But the ability to defend your revenue growth, I think that's something that's a lot more questionable, right? To give an example, we have seen a lot of companies competing in the AI image editing space and all this, right? Even a lot of the Chinese giants like Meitu and all this, they also have their own equivalents and they have added all sorts of AI features and all this. We have seen a number of these companies doing between 1 to 5 or maybe even 5 to 10 mil ARR basis, right? But the key thing is how defensible is it, right? Because you can have all the big giants coming in with their own features and they'll wipe out the smaller guys, right? So I think fundamentally, how a business should be building its moat is really quite important, right? It can be in the data, it can be in customer relationships, it can be other sort of stuff. But I feel that what the founders should help us investors understand is how you can build that defensible moat, right? Yeah, so I think that's really the most critical thing at the end of the day. But if you look at a layer below the matrix and all this, it's still the same set of matrix that we are evaluating, right? If it's a more consumer-facing like subscription business, we'll be looking at cohorts and all this. We'll be looking at level of stickiness, how much does it take to acquire a customer and all this. So all these core metrics, that hasn't really changed, right? But I do think how you want to convey the way your moat is being constructed over time and how it can be defended over time, I think that's very important, yeah.
So in almost going back to basics and really thinking through the fundamentals of what the business can be, or should be.
Yeah.
Okay. Navas, you alluded to a bit more uncertainty than I think Yongchen did. So how do you think about what you're looking for now?
See, I agree with what Yongchen said. Right? Basically, the considerations are still the same. You evaluate what the risks are, and of course, this is part of the risk, right? The environment. So if you really look at it, there was COVID, people didn't know how to protect businesses. There was volatile actually on a lot of tech businesses. What many people tend to forget in this direct conversation is that there is this whole thing that, in fact, even we are seeing a lot of the tech companies actually reducing their workforce on the tech side, on the development side, because AI can actually replace a lot of the workforce, which actually is adding to their EBITDA. So profitability is still king, right? I do believe that. The biggest question is, what is our job, right? As people who are in venture business, we're looking for venture businesses. What is a venture business? A venture business is something that grows. It will burn money, right? At the end of the day, we are open to looking at businesses that are EBITDA negative. But are we open to looking at businesses that are gross margin negative? That's a good question. So can we actually build businesses that are inherently not gross margin positive in Southeast Asia? I'm not so sure, because we're not talking about a large market. It's not like you can capture a lot of this market and then you can then monetize it somehow. I don't know. But that being said, I think what needs to happen a lot is also a lot of innovation. And from a lender perspective or from a debt perspective, we're always looking for companies that are generating revenue and generating revenue sustainably. If you don't grow enough, highly unlikely that you are interesting for either equity investor or a debt investor. Unless you're just building something like that's going to, in a way, you're going to be the founder, you're going to build that business. That's still a very good thing to do, right? You can still build your business, 5 million ARR, 10 million ARR, sell it for 100 million. You make a lot of money. A lot of people do that, right? But if you're building a venture business, then you have to actually think about, okay, I'm going to optimize my growth. I'm going to optimize my profitability. I'm going to think about who my customers are going to be. And I think very recently we had this Lightspeed report that came out, which was talking about the market, the difference in markets.
Resetting expectations.
Yeah, exactly. Yeah. Exactly. And I think it's such an important thing, right? See, you talk about population, but then population really doesn't matter. What matters with a lot of these consumer companies is the purchasing power of the population, right? So Singapore then becomes a very important market, but it's only 6 million people. So then do we build just for Singapore or do we build for other markets? We have to understand it's incredibly easy for a Chinese startup or an Indian startup to come to Singapore and build it for the region rather than a Singaporean startup to go back and build in India or China. I don't know why that is, but just the nature of business is so difficult, right? I still do believe cross-border is something that founders have to build on. And if you can actually scale across borders, that is a real indicator of the quality of the business, which will mean that anybody in the venture space will want to put more money into you. And I think the basics still remain the same. Forget about the risk, just keep on building. You need to build sustainable business. That's the basis of it. What that is, I don't know. If I knew, nobody knows. Anybody who tells you that they know what's going to be the next best thing, they're just lying. We just don't know. We just go with what we believe will work. There is an element of risk. He'll be underwriting what we call as the equity risk. I'll be underwriting what we call as the credit risk. That's the only difference.
Okay, and as you face as investors, this overall macroeconomic uncertainty, the tariffs are just one example. How does that influence your decision making today? You mentioned not taking calls for a few weeks, which is understandable, but do you think that this is going to be consistent behavior? Do we see that, how is your decision making shifting?
So we are a dollar debt lender, right? If you take our portfolio, a large portion of our portfolio are basically B2B e-commerce companies that are selling globally and have working capital requirements or have acquisition requirements, etc. Acquisitions, I still believe is going to be a trend, although we have to be really careful. But then working capital, especially for cross-border trade, is going to take a hit. No doubt about it, right? So there's no point actually for a Vietnamese startup to sell anymore to the US. They can, of course, they're trying hard, but it doesn't even make sense at that scale, etc. It's a big question mark. Countries like Bangladesh, India, everybody's hit, right? So there is a reset in how you actually are underwriting these businesses, because most of these businesses, especially B2B e-commerce businesses, have a gross margin of around 10%, right? If you're hit with a 30% tariff, that's the end of the story. A lot of the D2C e-commerce startups that were doing a lot of business between Asia and US is also taking a hit. Of course, cross-border trade is going to be viewed very closely as to what is the value that you could bring to the table. But there is a lot of opportunity outside of the US. That's what companies that are coming out of Singapore should start focusing on. We're building a business, and we've not seen too many B2B businesses being built in Singapore, to be very frank. But if you're really building something ground up from Singapore in the B2B space, then you should be looking at corridors outside of the US right now, at least until we have some more certainty in that space.
What are some of the corridors you're more optimistic about?
I think Middle East, yes, very much. I think everybody realizes it. Everybody from the top echelons of government here, everybody is making trips to the Middle East. I think there's a natural need for more consumption. There's more consumption there that we've been seeing. Naturally, the current US administration, for whatever reason, it seems to be a little bit more soft in the towards the region, which means that there's a lot of opportunity for Singapore to do a lot of business. Singapore has traditionally been very close to the UAE. Now they're warming up to Saudi. These are huge markets, especially Saudi is a huge market, consumption market. A lot of buying power there. So I think that's definitely a big corridor. I still believe some of the North Asian corridors that were interesting is still tricky because there's also a little bit of political uncertainty in some of those countries, sometimes unusual. But then, yeah, if you really ask me, take one, I would say Middle East. Africa is still a question mark, which is a collection risk. Europe is also definitely interesting. And I think what is interesting is that yesterday, if I'm not wrong, Mr. Ladashi mentioned that they need to create payment solutions outside of Visa and MasterCard. Singapore has always been really good for financial services. And building all these things will require a lot of financial services and solutions. And that's opportunity for you to sell. Cybersecurity. Cybersecurity is a big thing globally. And these are opportunities I think you just need to tap into and you need to identify. If your startup does not fit into these categories, doesn't matter, right? What matters is, do you bring value to somebody? And if you really believe that you can bring value to somebody, then that's it.
Cool. Yong-Chung?
Yeah, the biggest shift in mindset is on how we think about exit, right? So I think these days when we invest into any new company, we begin with the end in mind, which is how do we exit the company, right? I still remember when I first started out investing in venture capital, we're always talking about US IPOs and all this, right? But I think what a lot of people do not realize is that to be able to have a very liquid company trading on the US stock exchange, you actually need to have a sizable market cap, right? We are talking about anywhere between 3 to 5 billion USD, right? If we work it backwards, if it's a 5 billion outcome, and you're assuming a 10x EBITDA multiple, right? Then you need 500 mil of EBITDA, right? And assuming your company is a 10% EBITDA margin business, then that's how much revenue you need, right? I guess the numbers change, but the logic remains, right? I guess over the years, funds have also gotten a lot more realistic about the kind of outcomes that they can achieve here within the region itself. And I think Lightspeed has done good work with that report. With that in mind, how do we look at exit these days, right? Are we looking at IPOs on AXX, right, in Taiwan, in Japan, or locally within the different markets and all this, right? So I think that would influence how we think about a public exit strategy, right? And then on the M&A front, we're also seeing different trends and all this, right? We see a lot of interest from Japanese, Chinese strategics on license acquisitions here, right? It may not be in the fintech space. It could be in the offline, maybe not retail, but clinics and all this. They do need licenses on a per clinic basis. Yeah, a lot of these strategics are actually looking for licenses. So would that influence how we go about investing? Maybe not, right? But I think that's sort of how we think about investing these days. We need to begin with the end in mind, right? And I think that there have been a number of occasions whereby we also tell the founders, like, you're building a great business, but at the end of the day, it's more of a cash flow business, right? There's no need for you to seek venture capital funding, because with venture capital funding, it comes with a set of baggage and expectations, which not everyone is ready for it. And we do not encourage some of the founders to actually go ahead with it. It's not an easy game to be in. So you really got to have very vested interest and to really be able to commit, at least in the medium to long term. Yeah.
Along those lines, for the businesses where VC may or may not be the most suitable, under what conditions would you recommend they look at debt?
Okay, there are two kinds of debt, right? The debt that you can get in a regular business because your business is profitable, right? And there is venture-related private credit, right? So our business is largely, let's say, the venture-focused private credit, where you're looking at, hey, who are the sponsors of the business, right? And I believe that if you haven't raised at least 1 or 2 rounds of equity financing, then you cannot raise capital from a player like us. Doesn't make sense also, right? But that being said, there are a lot of financiers and banks and NBFCs around who can actually finance your working capital requirements if you have invoice discounting, and all those things, right? So you can do factoring. You don't really need to, your capital is not locked up in working capital, which is a big challenge for many businesses. Sometimes it's inventory that locks up your capital, right? Definitely there are solutions, and especially here in Singapore, you have a lot of solutions. Unfortunately, I believe ventures have not been able to take advantage of a lot of those things because we've not had the right kind of institutions And when you burn your hand, you start wondering, hey, what should we do this again? All startups are bad, etc., etc. I see you sleep off, but yeah, it's okay. But what I'm trying to say is that I think as a startup, it's very important for you to think as to what kind of capital you need, especially now, and who should be your partner on the cap table. The moment you take an equity from somebody, means he's going to come and sit either on your board or he or she is going to have some sort of a stake in your company. So I think it's very important for you to realize who you're partnering up with, number one. Number two, even debt. Because debt lenders, having a bad lender means end of story, right? But having the right lender means you're growing really well. Sometimes, especially in Singapore, I know that there is a lot of negativity around taking debt. And I want to try and understand why is that, right? Because obviously when we think about debt, we think about credit card debt. No, that's not the same thing, right? And this is a different story. You're actually not taking personal loan, you're actually taking corporate loan, right? And corporate loan without any implications on yourself, right? But if you do it right, it can be really helpful. But I also realized very recently that there is this whole issue of personal guarantees being asked by local banks when you raise corporate debt, which unfortunately is something that I highlighted a few times to people here. And I think we'll get it sorted. And this is something that once we do that, we really can overcome some of it. And I think it's a matter of the market maturing, also in terms of the appetite of the companies, etc. But yeah, I think in general, lots of things to be done. As a founder, I think you need not worry about it. You just focus on raising the capital, and then once you build the right company, the capital will just come. Because ultimately, everybody is looking to make. Our business is to make money, right? And how do we make money? We can only make money if we have good founders, good startups. You don't have to worry about it. Capital will keep flowing. Maybe at different paces, but it will keep flowing.
Okay, so one more question before we open up to the audience. If there's one word of advice you would leave with the founders who are fundraising, what would it be?
I think I will go back to my earlier response. Really be clear about where your boat lies. I think that's really the most important thing. Yeah.
I think just focus on your business, build the right businesses. I think there's no one advice that fits everybody. You're probably at different stages of your journey. If you've started a business and if you're at a stage where your business needs a push, then you really have to start thinking about, hey, what's going wrong? Can I do something, etc., etc. It's always good to take the right advice and move on and build your business. Never back down. That's something that I believe as a founder you should be. Never back down.
You mentioned at some point the notion of like growth, I think focus on like growth and like revenue. Are you focused more on growth, say on revenue, or more growth on profitability? At what point do you start shifting from, hey, like with what means are you actually achieving these results?
So I know there are some crazy theories around 40, 60, 40, 20, all these things, right? But keep it simple. When you're doing your business, especially, the basic thing is, what business are you building? Are you building a business where you want to exit, just sell your business out, you don't need any investors? That's one question. Second business is the business where you're raising capital, substantial amount of equity, etc., etc. There's the second kind, which is where you need the VCs and the venture private credit people. Then you obviously need to first prove your product market fit. Once you prove your product market fit, you need to be able to show that there's going to be scale in this business. Because as you mentioned, there needs to be an exit. When an investor looks at you, he or she needs to understand that there is an exit here. And the exit is only possible if you get to a certain scale. So I think depending on the business that you're building, growth is important. What is that does not translate to profitability? Sometimes it is CAC, unsustainable CAC. So you need to understand what is the right CAC, right? And then there is OPEX. OPEX is going down these days. Also, development cost is going down with AI, and development cost is going down. So this is good for companies, right? So I think as long as you have the basics right and you're growing sustainably, that's the first thing that you should focus on before really thinking about monetizing it, where you start focusing a lot on profitability. But I've seen companies that used to burn $40 million a month I've seen a company that burned $40 million a month and it is now burning $2 million a month.
Wow.
So it is doing the same level of growth. So it just doesn't make sense. This used to be an anomaly, right? I think people have just started realizing their mistakes. They started becoming grounded, and this is the right place to be.
For you, Insignia does multi-stage, right? In theory, anything from seed to upper end of growth. How do you guys think about the transition from growth in top line to growth in profitability?
Yeah, maybe to give an example, right? I think some of this, when this question is being asked, it also got to be taken into context as to how the broader competitive landscape will look like, right? But we actually have a company in the healthcare space that is growing roughly 2x a year, but it's still burning, right? So the question at this point in time is, should we get them to pivot to profitability in the absence of full-on funding and all this in this part of the world, or should we get them to continue to burn, right? So in this particular case, a lot of the US comparables they're actually growing 2 to 3x year on year, right? So if we get our portfolio company to get to profitability, they could be growing at maybe 1.5x a year, right? So for international investor that's evaluating these two set of companies in both regions, what would seem more attractive to them? So in this case, we're actually telling company, continue to burn, hit your minimum 2x year on year growth, right? Because if you don't do that, you will not be attractive enough for international capital to come in. There's no formula or, to Navas' earlier response, like a fixed answer to your question, right? You really need to evaluate your company in the context of a broader environment and all this, right? But I guess in this case, it's quite fortunate that they have direct comparables in the US. But for a lot of the companies that we are evaluating, that set of comparables may not be so clear. But yeah, that would be how we look at it, right? I guess another way to look at it is that if you have a comparable that is publicly listed, I think that's even easier, right? If your public comps is growing at 100% year on year, why would an investor come in when you are growing at 50% year on year? They would rather take that money and invest in a public company, assuming their mandate would allow that. So I think that's how we look at balancing between growth and profitability. Yeah. So I hope it gives a flavor. I know it's not answering your question, but I hope it gives a flavor for you to think about. Yeah.